Novices who want to invest in financial management are always faced with difficulties. In fact, in addition to understanding investment tools, they should also establish basic concepts of investment and financial management in order to avoid unjustified ways on the road of investment and financial management. The bumpy experience of investment novices. I believe you must have had such experience and heard many people say, "People don't manage money, money doesn't care about you." You want to start investing, but you are immediately faced with a lot of proper terms and find these investment tools difficult to understand. At this time, you find that the investment fund only costs $100. It is very suitable for yourself with less funds, so you choose a small fixed investment fund. But how to choose a fund? There are hundreds of funds on the market, and each of them seems to be very powerful, but they are so strange. After falling into the barrier of choice, you are probably the most popular fund to invest in, or choose randomly. If your relatives and friends say to you, "This fund is good," you will invest in this fund. But this kind of aimless investment method usually does not have very good results. 2 common mistakes in investment and financial management. The above-mentioned bumpy experience of investment novices must be the common blood and tears of many people. In fact, this experience actually made many mistakes. 1. Not thoroughly understood. Many people have heard other people say what investment is good now, and they don't understand the market and follow the trend to buy. In fact, investing is definitely not just about believing others. There are many factors to consider in investment and financial management, such as the overall economy, market prospects, corporate operating conditions, and even political factors, etc. Therefore, referring to one-sided information is not the most correct. 2. Human weakness. Many people buy when the target price rises and sell it when it sees a short-term decline, or sell it after earning 3% and miss the opportunity to rise by 30% later. In fact, this investment method that only follows short-term performance to buy and sell often buys high and sells low. 3 investment methods. For professional fund managers, most people cannot fight the market for a long time. Even the stock god Buffett does not rely on short-term buying and selling to become a stock god. Then how to invest correctly? Fortunately, Berger, the founder of Vanguard, gave us a good suggestion. He has been advocating 3 principles for investors all his life. 1. Spread the risk. Don't put eggs in the same basket. If you only invest in one stock, the final result depends entirely on the performance of that stock. But if you choose diversified investments, such as investing in different industries or different asset classes, you can effectively reduce investment risks. 2. Reduce investment costs. Cost is very important. Every dollar you save is like a dollar you earn. In addition to transaction costs, the cost of investment also includes holding costs. If you choose to invest in investment tools with high management fees, for example, a fund that charges a management fee of 2% per year, is such a rate really cost-effective for us? According to Berger's analysis of 30-year historical data, the performance of active fund managers often lags behind the index. The reason for the backwardness is actually the fees charged by the managers, but these fees are often internally deducted, so we have ignored them. 3. Long-term holding. Most investors adopt short-term investment strategies, buying and selling frequently, and want to buy at low points and sell at high points. First of all, frequent transactions will only continue to increase transaction costs. In addition, it is very difficult to buy at the right time. But as long as the investment time is long enough, even high-risk stocks can reduce their volatility. Wharton Business School professor Jeremy Siegel researched data from 1802 to 2012 and pointed out, if you hold stocks for 1 year, the volatility of assets will exceed 18%. But if the holding period is extended to 30 years, the volatility will decrease by less than 2%. In fact, as long as the investment period is extended, the asset level would be very close despite entering the market at different times. If you want long-term investment, you should master ETF. ETF is the best tool to diversify risks and reduce investment costs. In addition, for people with mediocre incomes, regular fixed investment ETF, monthly investment of a fixed amount, continuous accumulation of positions, while saving money for yourself. You can also earn long-term investment compound interest cumulative return. Berger's 3 suggestions: diversify risks, reduce investment costs, and hold for a long time. It sounds simple, but it is not easy to implement. After all, the weakness of human nature is often our biggest test. Thanks for watching. See you next time.